Hello class, this is chapter 8. We're looking at corporate finance, accounting 350. We're going to take a look at risk and rates of return. Learning outcomes. Number 1, explain what it means to take risks when investing. 2, compute the risk and return of an investment and explain how the risk and return of an investment are related. 3, identify relevant and irrelevant risk and explain how irrelevant risk can be reduced. 4, describe how to determine the appropriate reward, that is rate of return, that investors should earn for purchasing an investment. 5, describe actions that investors take when the return they require to purchase an investment is different from the rate return they expect the investment to produce. And 5, identify different types of risk and classify each as relevant or irrelevant with respect to determining an investment's required rate of return. So defining and measuring risk. Risk is the chance that an unexpected outcome will occur. A probability distribution is a listing of all possible outcomes with a probability assigned to each. So it either will rain or it will not rain. There are only 2 possible outcomes. So rain is 0.4 equals 40%. No rain, 0.6 or 60%. So remember they add up to 1. And down on the right here, they add up to 100%. So this is a lot of statistics here. Probability, so that's kind of what we're looking at. So Martin Products and U.S. Electric, state of the economy, boom, there's a 2.2 or 20% chance, normal 0.5, recession 0.3. So here's the probability of this state occurring. Remember that to equal 1. Rate of return on stock if the economic status occurs. Martin Production 110%, U.S. Electric 20%, normal 22, 16, and then over here minus 60, and right here is 10. Okay. So we'll take a look at that a little bit more in detail. Expected rate of return, rate of a return expected to be realized from an investment during its life. Mean value of the probability distribution if possible returns. Weighted average of the outcomes where the weights are the probabilities. So here's expected rate of return. It's going to equal P R1 probability 2 rate of return, probability of n rate of return. So r hat equals summation of n as I approaches 1. So probability of I and then rate of r sub I. So total risk, standalone risk, the standard deviation. This is a standard deviation symbol. Standard deviation, this big old long equation, R1 minus R, so squared, P of R1, probability 1, plus R2 minus R hat squared. So anyway, this formula right here, actually, if you notice the difference, you're combining them and you're squaring them. This is kind of similar to we kind of looked at this in whenever you took college algebra. Okay, so we're squaring to see what this would look like. So if you were to break it down, this equation here kind of is the summation of all of this. If we took this to the 1, to the 2, to the 3, to the 4, to the 5, and so on, that's what this is saying to the n power, or to the power of n, not the power, but to the nth term. Okay. So here we go. Martin Products 1 minus 2 here, and then this will give us equals 3 here. So the square of that is going to be 4. Okay, and then so 110% minus 15% gives us 95. And then 22 minus 15 gives us 7. Negative 60 minus 15 gives us negative 75. Okay. So, and then if we square that, we get 9,025. Square 7 gives us 49. Square negative 75, and negative times a negative is a positive 5625. Okay, now we're going to take 0.2 of it, 0.5 and 0.8. Remember, this adds up to 1. Okay, so whenever we multiply that, we get 1805. 49 times 0.5 is 24.5, and 3/10 of 5625 gives us 1687.5. So the variance or standard deviation squared is going to equal 3,517. Okay, so again, standard deviation, what we're doing is we're taking the square root of the standard deviation square, so that cancels there if you really think about it. So the square root, so we squared these here. If you look at this right here, that's kind of what we're doing right here. So the square root of 3517 gives us 59.3%. Okay, so plus or minus the standard deviation. Remember, if you remember a perfect distribution or a bell curve, we're looking at the standard deviation right or left, or plus or minus. So estimated standard deviation. So this is kind of our estimate right here. Okay, so take this to, I know these equations don't make sense unless you put numbers in there, so we'll take a look at this a little bit more in detail. So this is saying the sum of this, okay, to the nth power, or to the in terms. So measuring risk coefficient of variation calculated as standard deviation divided by the expected return. Useful where investments differ in risk and expected return. So coefficient of variation, C of V, is risk divided by the return. So this is our standard deviation by our return. Okay. So risk aversion and required returns. Risk averse investors require high rates of return to invest in higher risk securities. Risk premium, RP, the portion of the expected return that can be attributed to an investment's riskiness. The difference between the expected rate of return on a given risky asset and that on a less risky asset. So risk over return relationship. Okay, so our return is on our y-axis and our risk is on the x-axis. Okay, so risk-free return, as long as we're in this area, plus inflation, okay, it equals our risk plus inflation right here, inflation premium. Payment for risk premium, RP here. So when we take a look at this, below average risk in this area, average risk in this area, and then above average risk over this area. So as you notice, as we become higher, as the risk increases, our return increases as well. But if you do low risk, your return is not as high. Okay, so you're getting a low rate of return. So sometimes you have to balance this out whenever you look at it, but that's really typically true. The more risky your investment, the higher return you can get on your investment. Portfolio returns, expected return on a portfolio. Okay, so here's a portfolio return, or a P, or a P equals W to the 1 over R to the 1. So all of this, if you go, this is to the 2 all the way to the in terms, so in summation. So all we're doing is summing all of these. 1, 2, 3, however we go up till J equals 1. Okay. The weighted average expected return on the stock's yield in the portfolio. So realized rate of return is this R with the 2 little dots on top. The return that is actually earned. Actual return usually differs from expected return. So we're looking at risk still, correlation coefficient. Okay. So measures the degree of relationship between two variables positively correlated. Portfolio risk is going to be greater than 0. Have rates of return that move in the same direction. Negatively correlated. The correlation coefficient is going to be less than 0. Have rates of return that move in opposite directions. Okay, remember, greater than 0, positively less than 0, then it's negatively correlated. Okay, so those are important. That is taken into account. If your correlation coefficient, if it's positive, if it increases from left to right, that's positive. If it's less than 0, then it's going to decrease like this. I don't know if you can see it up here, but that's negatively correlated. Risk reduction, combining stocks that are not perfectly correlated will reduce the portfolio risk through diversification. The riskiness of a portfolio is reduced as the number of stocks in the portfolio increases. The smaller the positive correlation, the lower the risk. The greater the negative correlation, the lower the risk. And if you're actually watching the market right now, the market has actually decreased significantly. I think they were saying that there's been a 4 or 5% decrease in the market. Also, if you're watching in today's March, what is this, March 9th, the market kind of took a tumble because of Saudi Arabia dumped a lot of oil into the market. So the oil, I think oil is about like probably $26, $27 a barrel. There was a deal that was supposed to happen with Saudi Arabia and Russia didn't agree to the terms, so they flooded a bunch of oil into the market. So our portfolio there's a lot of risk going on right now, so you can definitely see the variation in the market. Portfolio risk. Okay, so here's what we're looking at. All in New York Stock Exchange, minimum attainable risk in a portfolio of average stocks, diversifiable risk related to company-specific events, unsystematic risk. So we're taking a look at this. Here's our portfolio risk at 30. Here's 0% all the way to 30%. Okay, and then here's our non-diversifiable risk related to market economic fluctuations, systematic risk. So this is one thing to take a look at whenever you're looking at fluctuations in the market. Sometimes people buy when the market is low, like during recession. People that are have a lot of equity, right? Have a lot of cash or liquid. People that have liquid assets that can be turned to cash immediately will usually buy when the market is low. Okay, so and then that's how they actually make money really quickly, because once the market hits the bottom, it can only go up. Okay, so you got to know when to take that and reinvest it. Firm-specific risk versus market risk. Firm-specific risk, that part of a security's risk associated with random outcomes generated by events or behaviors specific to the firm. Firm-specific risk can be eliminated through proper diversification. Again, sometimes whenever you get a portfolio, sometimes you'll have a certain percentage in high risk, medium risk, and low risk. So you're diversified across those I guess different types of investments. But honestly, well, I'm not going to say honestly, but if you look at the market, they say that the market traditionally increases 5 to 6% per year historically. Actually, I've seen sometimes 6%, sometimes I've seen 9%, and that's the S&P 500 over the last probably 100 years. They keep a lot of data, so that's sometimes you can look at that. Also called diversifiable risk or unsystematic risk. Okay. So here's market risk, that part of a security's risk that cannot be eliminated through diversification because it is associated with economic or market factors that systematically affect all firms. For example, the market decreasing or tanking in the last couple of weeks, that's systematic. It's affecting everybody. And I think part of that is because of the virus as well, the coronavirus. So, also called non-diversifiable risk or systematic risk. In fact, I just pulled some of my investments out of my high risk or high risk bonds or high risk securities, and I kind of packed it out and kind of liquidated some of my assets because it was really volatile at this particular moment. So relevant risk equal market risk, the risk associated with a security that cannot be diversified away. This risk reflects a security's contribution to the total risk of a portfolio. Irrelevant risk, firm-specific risk, the risk associated with a security that can be diversified away. So the concept of beta coefficient, this is the beta coefficient, a measure of the extent to which the returns on a given stock move with the stock market, which represents an average stock. The entire market is extremely well diversified, theoretically perfectly diversified, because it includes all investments. So the beta of 0.5, the stock is only half as volatile or risky as the average stock. A beta of 1, stock has the same risk as the average stock, same as the market. 2.0, stock is twice as risky as the average stock. Okay, and the beta of any set of securities is the weighted average of the individual security betas. Okay, so we're looking at the weighted average. So whenever you look at this 1, 2, 3, all the way to n, or n times, then this is the summation of all of these. That's all this is saying. I don't know if you've seen this symbol coming up, summation of these investments, or these the average of all of these investments is what it's looking at. So risk premium for stock of J equals RP of J. So RP of J equals the beta of J. Okay, so RM minus RF, R sub RF times beta J. Okay, so market average risk premium, RPM. Sounds funny, RPM, sounds like a car. So market average stock return, this is what it's throwing the market return, and then the risk-free rate. We've seen risk-free rate before. Okay, obviously B of J is the beta of J, which in the previous slide we looked at the beta, the beta coefficient. So required return equals risk-free return plus risk premium for risk. So R of F, or risk premium of J, risk premium of M, the beta of J, so the difference in that and the beta of J. Okay, so this is kind of looking at it and expanding it out a little bit more. Capital asset pricing model, CAPM, a model used to determine the required return on an asset, which is based on the proposition that an asset's required rate of return should equal the risk-free return plus a risk premium that reflects the asset's non-diversifiable risk. So required return equals risk-free return plus risk premium for systematic risk. Okay, so R of J equals R of risk-free, and here's our risk premium for systematic return, and we're using the beta of J. So a graph of CAPM, the line that shows a relationship between risk as measured by beta and the required rate of return for individual securities. Okay, so here's what we're looking at. Here's our line. So if you look at this, this is a positive correlation. This beta J here is a positive correlation. Again, high risk over here, rate of return, and our relevant risk over here. Okay, but again, this is saying as your relevant risk increases, your rate of return also increases as well. Okay, but that's where you got to find the sweet spot. It's what people talk about, the sweet spot where you're managing your risk. Okay, that's where I'm saying whenever you have high risk bonds, your rate of return is higher. Well, I've been doing that for the last year, and I was at 9%. I made 9% on my initial investment. So what that means is if I invested $1,000, then I made 90 bucks. I don't know if that makes sense. But the thing is, then that's 9%. But if I would have done a bond, a regular government bond, then my interest is 5%. So my risk is less. Notice how it says right here, risk-free rate, 5%. Well, if I were stuck with a government bond, I could probably get anywhere from 3 to 4%. But I'm not getting a lot. My required rate of return isn't very much. Okay, so keep that in mind. Now notice how this is 6%. Well, I was getting 9%. So then but the thing is, that's where you have to take into account the sweet spot. I was starting to lose money. My 9% over the last couple of weeks started to go to 8%. I pulled out, I guess I should say, I liquidated and sold my investments, and I ended up cashing out at about 8%. Okay, so but then I was like, well, I started losing money, and I didn't want to lose too much, so that's why I pulled it out. But the thing is, let's say that 90 bucks on the $1,000. Here's the interesting part: is that I'd have to pay taxes on those capital gains. The difference, if my principal was $1,000 and my investment yielded $90, the capital gains on that would be $90. So that was what I'd probably be required to pay tax on, unless I can take that 9% and roll it over into another investment. Okay. The impact of inflation, R of F, is the price of money to a riskless borrower. The nominal rate consists of a real inflation rate. They say 2 to 3% for inflation rate of return, and an inflation premium IP. An increase in expected inflation would increase the risk-free rate. The SML would experience a parallel upward shift. So the slope of the SML reflects the extent to which investors are averse to risk. An increase in risk aversion increases the risk premium, which increases the slope of the SML. Okay. Changes in a stock's beta coefficient. The beta risk of a stock is affected by compositions of its assets, use of debt financing, increased competition, expiration of patents. Any change in the required return from change in beta or an expected inflation affects the stock price. Stock market equilibrium, the condition under which the expected return on a security R is just equal to its required return. Actual market price equals its intrinsic value as estimated by the average investor, which leads to price stability. Otherwise, buying or selling in the market makes the appropriate adjustments. And that's the thing, like there's a market equilibrium that typically happens. There's always a balancing out that occurs. Change in equilibrium. Stock prices stock prices are not constant due to changes in risk-free rate, market risk premium, stock's beta coefficient, stock expected growth rate, G, and changes in expected dividends. This is our these are I like the way this is set up right here because it really explains the risk-free rate and then the market risk premium. Okay, the betas. This is really nice. If you get a chance, screenshot this or take a picture of it because this is a really good explanation of it. Physical asset versus securities. Riskiness of real assets is only relevant in terms of its effects on the stock's risk. Word of caution, cap M based on expected conditions only have historical data. As conditions change, future volatility might differ from past volatility. And again, you're looking into the future, so you really don't know. Okay. Estimates are subject to error, and there's a lot of error. Okay, so that's some things that you need to take into account, or corporations need to take into account. Different types of risk: systematic risks, interest rates, inflation, maturity, liquidity, exchange rate, and politics. Okay, this politics is whenever like the Fed chairman tries to raise interest rates or lower interest rates. That's the interest rates where people can borrow money. Okay, so keep that in mind. That's why it says politics. Different types of risk: unsystematic risk, business, financial default, and combined risk, total, and then corporate. Okay, that's the end of this chapter. Let me know if you all have any questions, and I hope you're enjoying this class. I really enjoyed teaching it, and I think everyone's doing really well with the class. Midterm is coming up, and make sure you get your midterm submitted. Thank you, and have a good night.